2008. While Lehman Brothers was collapsing and every major hedge fund on Wall Street was hemorrhaging capital, Ray Dalio's Bridgewater Associates returned positive 9.5%, in a year when the S&P 500 lost 37%. But that's not the shocking part. The shocking part is why it happened. And it traces back to a catastrophic personal failure in 1982 that nearly destroyed him completely. That failure didn't just teach him a lesson. It rewired the entire way he thinks about money, risk, and where in the world the next great opportunity is hiding. Right now, in 2024, Dalio is making a bet that most investors think is borderline reckless. He's moving into emerging markets. China, India, Southeast Asia, at the exact moment retail investors are running for the exits. The question is he seeing something you're not? What Dalio built in the wreckage of 1982, and the single framework he extracted from nearly going broke, is what this entire video is about. Because that framework didn't just save Bridgewater. It's the same logic he's applying to a $150 billion global macro thesis right now. And the principles behind it are something you can start applying to your own portfolio today. But first, you need to understand how close Ray Dalio came to losing everything. It's 1982. Ray Dalio is 33 years old, running a small operation out of his two-bedroom Manhattan apartment. He goes on national television, Wall Street Week with Louis Rukeyser, and predicts an imminent economic depression driven by over-leveraged U.S. banks and a sovereign debt crisis in Latin America. He is completely, catastrophically wrong. Instead of a depression, the stock market launches into one of the greatest bull runs in American history. The Dow doesn't collapse. It explodes upward. Dalio's fund is wiped out. His employees are gone. He's so broke he has to borrow $4,000 from his father just to cover his personal expenses. He later described this moment in a 2017 TED Talk as the most painful experience of my life. Here's the personal detail most people don't know. Dalio was so humiliated by that public failure that he briefly considered quitting finance entirely. He almost took a job as a commodities trader just to survive. Instead, he did something that changed everything. He sat down and asked himself one question. What would I have to believe to be so wrong? That question became the DNA of Bridgewater. He stopped making single bets. He started building a machine that could be right even when his assumptions were wrong. The all-weather portfolio, the concept that made Bridgewater the world's largest hedge fund, managing over $150 billion at its peak, was born directly from the ashes of that 1982 disaster. And the reason this matters right now is simple. In 2024, Dalio is applying the exact same contrarian logic to emerging markets. And the stakes are enormous. Dalio's core insight from 1982 was that no single person, not even him, can reliably predict macro outcomes. So instead of forecasting, he engineered a portfolio that could survive any environment. The all-weather framework allocates capital across assets that respond differently to inflation and growth. Roughly 30% equities, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, and 7.5% commodities. In 2008, while the average hedge fund lost 18%, all-weather lost just 3.93%. In 2010, it returned 18.9%. Here's how you apply this with a $10,000 portfolio. Rather than chasing whatever sector is hot, allocate across 4 uncorrelated buckets. Domestic equities, 30%. Treasury bonds via TLT, 40%. Gold via GLD, 7.5%. And a commodity ETF like DJP, 7.5%. Rebalance quarterly. You're not trying to win every year. You're trying to never get wiped out. Dalio's 2018 book Principles for Navigating Big Debt Crises analyzed 48 major debt crises across 100 years. His conclusion: the template repeats. Countries accumulate debt, hit a ceiling, devalue their currency, and reset. Right now, Dalio argues the United States is late in its long-term debt cycle, with federal debt exceeding $34 trillion and a deficit running at 6% of GDP in peacetime. A historically unprecedented figure. Emerging markets, specifically India, Indonesia, and parts of Southeast Asia, are, by contrast, early in their debt cycles. India's debt-to-GDP ratio sits around 83%, high for an emerging market but with a trajectory of structural reform. Indonesia is at 39%, lean, growing, and demographically explosive with a median age of 29. In Q1 2024, Dalio's Bridgewater added exposure to Indian equities and increased its position in Chinese government bonds, even as Western institutional capital was exiting China at the fastest pace since 2015. Here's the retail application. Track the debt-to-GDP ratios of the countries you're investing in. Use ETFs like INDA, iShares MSCI India, or VWO, Vanguard FTSE Emerging Markets, to gain diversified emerging market exposure. Even a 10% allocation in a $10,000 portfolio, $1,000, positions you in economies that are 20 to 30 years behind the US on the debt cycle clock. Dalio calls this the holy grail of investing. His research showed that adding 15 to 20 truly uncorrelated return streams to a portfolio doesn't just reduce risk marginally. It can cut your risk by up to 80% without sacrificing returns. The word truly is doing all the work in that sentence. In 2010, when Bridgewater began building its Pure Alpha fund, Dalio was searching for assets that moved independently of U.S. equities and U.S. bonds. Assets that had their own economic drivers. Emerging market equities, driven by domestic consumption growth and local monetary policy, fit that description in a way European stocks simply don't. During the 2022 U.S. equity bear market, when the S&P 500 fell 19.4%, the Indian Sensex index gained 4.4%. That's not luck. That's uncorrelated returns doing exactly what they're supposed to do. But here's the part of Dalio's philosophy that almost nobody talks about. Dalio publicly champions systematic, emotion-free, algorithmic decision-making. Bridgewater famously runs on a radical transparency model. Every meeting recorded, every decision logged, disagreements aired openly. The machine decides, not the man. Except, here's the paradox. Dalio's biggest bets have consistently been deeply personal and deeply human calls. His 2011 conviction on gold, which drove Bridgewater to hold over $11 billion in gold-related assets at peak, wasn't purely algorithmic. It was Dalio's personal reading of government desperation and currency debasement. His current thesis on China, which he has defended publicly and persistently even as geopolitical risk mounted, is a philosophical stance, not a model output. The one thing Dalio's framework cannot protect against is the risk that his own pattern recognition is anchored to a historical template that no longer applies. His debt cycle model is built on 100 years of data from economies that operated under the Bretton Woods system, the petrodollar, and relatively stable geopolitical order. None of those conditions are guaranteed going forward. If the US-China decoupling accelerates, if dollar dominance fractures faster than the debt cycle predicts, Dalio's emerging market thesis could be early by a decade. And early, in leveraged macro investing, is indistinguishable from wrong. And that's why the most important thing Dalio has ever said isn't about markets at all. It's this: he who lives by the crystal ball will eat shattered glass. The all-weather portfolio exists because Dalio doesn't trust his own predictions. The question is whether he still remembers that when the conviction is this strong. Here's the distilled takeaway. If Dalio's framework were applied to a retail portfolio today, it would suggest 3 specific moves. First, a 10 to 15% allocation to emerging market equity ETFs, INDA, VWO, or EEMS, to capture early cycle debt dynamics. Second, a meaningful gold position, minimum 7 to 10%, as insurance against the late cycle dollar debasement Dalio considers near certain. Third, a reduction in long-duration U.S. Treasuries below the traditional all-weather weight, because Dalio himself has warned that U.S. bonds face structural demand problems as foreign central banks diversify reserves away from dollar assets. This isn't a get-rich-quick framework. It's a don't-get-wiped-out framework that also happens to position you in the economies that could generate the highest growth over the next 20 years. But there's one more thing Ray Dalio believes that most people find genuinely controversial: his view on what's coming for the US dollar's reserve currency status and the timeline he's put on it. That conversation is for another video. Here's what I want to know. Do you think emerging markets, specifically India and Southeast Asia, are the single best risk-adjusted opportunity of the next decade? Or is geopolitical fragmentation and dollar weaponization actually going to make these markets uninvestable for Western retail investors? Drop your take below. If Dalio's debt cycle logic resonates with you, the next video you need to watch is on Stanley Druckenmiller, the man who disagreed with Dalio on China, shorted the yuan in 2024, and explained exactly why he thinks the greatest macro trade of the decade is against emerging markets, not in them. 2 legends, completely opposite bets. One of them is going to look like a genius in 5 years. The next video breaks down why.